Hello, everyone. So, what we're going to do this week, we're going to dive into this rotation trade because I want to understand what's going on. I want you to realize a few things. First of all, yes, I'm going to show you a couple of good names, right? That's the first thing. The second thing I'm going to show you is what are the pundits are doing? What are they saying to you? What are they trying to sell you? And then we're going to take a look at how our portfolio is doing, right? So the first thing you need to understand is that, as I always say, you need to make up your own mind. You need to decide what you want because this is what this channel is about. This is about the investor, right? The smart investor. What is a smart investor? A smart investor is not the investor that just listen to everybody else and say, oh, look what CNBC is doing. Oh, look what this guy, look what Tom Lee is doing, and blah, blah, blah. And let me listen and make decision based on that. Do not do that. I don't believe in telling you what to do. I do believe, and I do that a lot with my students and my investors and for myself. I do believe in understanding what is going on. I do believe in figuring out what is really going on here. And what is really going on is why don't we start by listening to what they're telling us is going on, right? So we got CNBC and Tom Lee, for example. What's going on there?
Is Tom Lee. Thank you for being here, Tom Lee. I don't even know if you need an introduction at this point. People tune in to hear.
Okay, as you could see already, tech wreck causes market meltdown. So what's going on? Well, essentially, the valuation on tech stocks are pretty high. And everybody's taking a breather and they're saying, ooh, what's going on? What's going to happen next? So let's ask the guys that know, right? Because so they know. Think about this for a second. They're going to tell you what's going to happen next. Wow. So you're going to tell me the future. You're going to predict the future to me. And CNBC and these guys are going to put you on to tell you what's going on. I wonder why.
Sometimes it's almost like a salve. And I think you're going to give us a little bit of that today for our wounds from yesterday, but not entirely, because you think the S&P is probably going to be flat for August overall.
Yes, that's right.
And that's unlike some of your recent calls about the S&P with friendlier inflation data.
Now, one thing you need to realize, when we talk about the S&P, right there, be careful. Because the S&P, yeah, it's S&P 500 stocks. Well, I mean, that's diversification. Stop it. It's not diversification. Because technically right now, these guys are being driven by a few stocks, the Magnificent Sevens. You already know that? Fine. But just keep in mind that when we're talking about the S&P 500, it's more like the S&P 7. Okay? So
you've made some calls about some big near-term moves. That's not what you're saying today, unless you're talking.
As you could see, of a couple of days ago, the S&P is down 2.3%. But we should say the top 7 names are down 2.3%. We're talking about NVIDIA, Apple, and all these guys, right? The valuations are just exploding all over the place. Okay?
Small caps.
Yes, that's right. I think part of what we saw yesterday was, the rotation that's painful away from.
Here we go. The word is out. Rotation. What is rotation? Well, basically, we'll be making lots of money with the big stocks. Now we are rotating. We are moving the money in the small stocks, supposedly.
Caps, and I think Tesla earnings and Google sort of accelerated some of that.
Meaning that Tesla didn't do that great. And they say, oops, you see, we should have never invested in Tesla. We've done too much with Tesla. We spent too much on Tesla. Valuation is too high. So it's time to move away from Tesla. Let's find out where the next golden goose is.
And I think there's been some uncertainty about the Fed's commitment to cutting, even though.
The Fed uncertainty to cutting. What does that mean? Well, basically it's telling you that the Fed is seeing that inflation is not gone, and they expect to lower the rates to fight inflation, but at the same time they don't want to keep it too high because then you're going to cause a recession. Now keep in mind, when we go into a rotation to small stocks, you end up with small stocks, and if the economy is not doing well, they're not going to do so well either. So keep that in mind.
We expect inflation to fall like a rock, but when the Fed starts cutting, that's good for small caps. And
well, hold a second. Sure, it's good for small. It's good for everyone when rates are low, right? Because what he's saying is that the small stocks need financing to keep going, because that's how you grow. But obviously, you don't want to pay too much in rates, so that's good for them. But the market is a bit of funky, a little bit animal. You know why? Because if you lower the rates, you could say, well, that's because the Fed is lowering the rates, not to make it easy for you to finance. No, they're lowering the rates because the economy is slowing down. We may end up in a recession. So how is that good?
has been, I think, overseas some unwind of that Japan carry trade that's hurt the NASDAQ. But to me, this is why.
As you could see, look at those rates, 4%. The Fed wants these numbers to be closer to 2%. Now at 4% Treasury, Treasury is basically the for the best of the best customers, right? So you're not ever going to get 4%. If you want to borrow on a house, it's going to be like 7%, and including if you're a small business. So you want that rate to go down.
S&P had a great first 6 months. Maybe it needs to consolidate those gains, but now Russell 2000 has an 11 median PE.
Now, as this guy is talking, Tomley, I don't know the guy personally, but I will tell you, he's hired by CNBC. CNBC is basically looking for what here, right? The good guys, right? They've got about 100, I would die for these kind of views, 165,000 views of people watching this thing and saying, oh, what is he saying? But he's telling you what he feels, but he's also, an advisor, and he's also a CNBC contributor. So he's getting paid for this. He's getting paid to obviously keep you interested. Now, keep in mind, if you were to say, guys, get out of the market, you don't want to be in it, go buy gold, go buy real estate, get out of the stock market, there's nothing to talk about, this is a horrible thing, nobody will be watching. Right? So they want you in, they want you invested. So are they going to tell you that they don't like what they're seeing and they want you out? No, they want you invested. Or in this case, they want you to watch, right? Because the more you watch, the more it's best for CNBC, because obviously that's how they make money with the advertisers. Hey, it's totally fine with me. But my point to you is you need to know what's going on. You need to realize what's going on. You need to understand the concept. You got to be like Socrates, right? Socrates asked questions about everything, or Larry David, on that show on HBO. Right? You need to know what's going on. You need to ask questions. It's annoying at some point, obviously, but you need to understand. So he's basically helping you, even though he doesn't know you, but he's helping you make up decision. But keep in mind that he's got vested interest to obviously tell you a nice story.
Earnings growth 800 basis points faster, and it just posted 11 days where 10 out of 11 days had a 1% move. The 9 times it did that.
So now he's basically saying that, oh, look, you know what? The S&P is not doing so well, but the Russell 2000, that's moving. And the Russell 2000 is basically a bunch of small companies. Therefore, the rotation from the S&P to the Russell 2000.
1979, when you weren't in a bear market, we were up 100% 1 month, 3 months, 6 months, 12 months later.
The idea being that, oh, look, if you look historically, that kind of pattern that we've seen basically tells us that we should see the same pattern again. The way it happened in the past is going to happen again, and therefore you should see some gain in small company stocks. This is purely technical, purely looking at charts, right? Now, I'm not saying it's wrong. It's like saying, well, I did well in the past. I never got sick in the past, so I'm pretty healthy, so therefore I'm not going to get sick in the future.
Average gain 40%.
You're very popular, and I would warn you this is not good that you're saying this. You think this rotation has been driven by expectations of a Trump White House?
Whoa. So now, in addition to historical perspective, we're saying, let's bring the election in this thing, right? That somehow if Trump wins, it's going to be good for stocks, and they know what's happening. And this is nothing to do with financial. When I teach finance, this has nothing to do with finance, right? It has to do with some guy coming in, being elected, and this is good for stocks. Based on what?
Another way you can say that, can you come up with something else so you don't have to delve into the political side? You think Trump's going to win the White House, or you think the market at this point thinks he's going to win the White House?
Yes, it's the second.
Okay.
Betting markets are putting a 65% probability of a Trump White House.
Now, look at this. Fundstrat Global Advisor, Managing Partner and Head of Research. So he has his own book that he's running, and he's basically telling you, you know what, I have a Mercedes, I love it, buy one, it's a great car. Oh, by the way, I have to tell you, although they actually don't actually say it, but I'm being paid by Mercedes to sell cars. He's not going to tell you, do something that he's not doing.
The biggest beneficiary, which is deregulation, M&A, regional banks doing better, that's small cap stocks.
Okay, so that's the linkage that you're seeing.
I mean, and obviously the other guy is basically, so what you're saying is what you're saying is that, yeah, of course. Well, I mean, okay, he comes in, he deregulates everybody does whatever they want, and this is good for the economy. Well, I don't disagree. Yeah, sure, you have no regulation, it's going to be positive for the small stocks. But we're going to lower taxes? Yes, it's great but how are we going to fix the debt then? Right? How are we going to take care of this amount of money that's growing every time? I mean, yeah, you could, these are all the issues that could drive the stocks, and you're just focusing on this. It's going to be good for them. Well, what about the rest of the stuff? Well, I don't have time. Well, but then you should at least mention, which is what I'm doing, that there are other elements that you need to be worried about. It can be that simple that let's look at the fact that there's going to be deregulation that's good for stocks. That's like talking to a child, right? Oh, is Santa Claus coming to town? Does Santa Claus exist? Well, I'm not saying he doesn't exist because you're 6 years old, but Santa Claus could be viewed in different ways. Well, maybe he comes, maybe he doesn't. I mean, somebody does give you presents, so right. And Santa Claus is supposed to give you presents, and you have presents, therefore Santa Claus does exist. But I don't want to make you feel bad. And who knows what we mean by Santa Claus. But what are you saying? Right? You're just selling me a very narrow idea. Not that it's wrong, again, but I'm just telling you what they're doing.
So you really think we've seen a Trump trade? And even after, I mean, the betting markets have...
So now, we're talking about rotation trade, Trump trade, right? Easy concept for you to grasp.
Moved somewhat. He's come down. Vice President Kamala Harris has moved up a little in the betting market since
He did use the word betting.
Again, when the news came out, you still think that that's at play from here on, not just to explain the rotation that we've already seen. You think it's going to continue? That's
right. So I think it's from this point forward, there's a lot of opportunity in small caps.
That's right. Lots of us want opportunity in small caps. I wonder what this portfolio look like. Again, not I'm saying he's wrong, but does he have small stocks? Because if he owns a small stock and he recommends a small stock, he's always on TV, right? What is he going on TV for? Because he's studying what he thinks is going to happen and probably tied to what he has. And if it goes up, you say, I told you guys it was going to go up. Well, you told everybody it was going to go up, and people listen, they buy, then it goes up.
It is that there's a lot of overlap. When the Fed cuts, that's lowering cost of money. That's good for small caps and the regional banks. It probably boosts CEO confidence, which is M&A, and that benefits small caps. So there's a lot of overlap between
We believe small caps could rise 15% more in August. In August, 15%. Now, that's 1 month times 12. That's at least 150% in 1 year. annualized. And he's talking small caps. He's not talking about one stock. He's talking about all of it. So there's going to be a huge wave going up. We're going to be tracking this.
Fed cut imminent in a Trump White House, and that's why I think the interplay is positive for small caps.
Interesting. So
I still don't understand. You don't think the large caps are done. You just think it's a slowdown for.
You say, well, hold on a second here. Are you saying that we're done with? So it's over with the large caps. So Nvidia is over and Telsa is dying. It's over. It's finished.
The S&P 500 on a broader level?
Yes, that's right. I think the Mag 7 was very attractive at the start of this year because growth was scarce and they've had great visibility. And they're not expensive. 27 times earnings isn't demanding.
Oh, so what he's referring to is a P/E ratio. So how do we measure something? How do we measure what something is worth? Well, the P/E ratio. What is a P/E ratio? It's the price of earnings per share. What is earnings per share? What's your net income? I mean, if you look at an income statement, you start from sales, growth, everything. The last item is net income. And that's not cash flow. That's just a number that's left that we use to basically do relative value analysis. That is not intrinsic value, real value. How much money you actually making. Well, look, I'm making $10 and I have $5 of expenses, so I made $5. Well, but I have to pay taxes and I have some kickbacks and I have some money coming in, coming out, whatever. I end up with $1. So how much money did you really make? Is it your sale or is it the bottom line? And usually theory tells you that you need to look at the cash flow. The cash flow is what counts. But the market or these guys don't use a cash flow, they use a P ratio because it's easy to calculate. It's easy for you to understand because you take the price, you take the earnings per share, and you divide, you have the P. Now, at the end of the day, they might be right in the sense that, I don't care, what it's really worth. All I know is all these people in ties and suits and Rolex watches, they buy it. And the multiple is high. So therefore, they must be knowing something or doing something, right? But it doesn't mean that's what's really going on. That's just a view on value.
But now that there's a visible catalyst for small caps, I think investors are taking some profits up. NASDAQ was up 20% and putting it into small caps.
So basically they're saying, hey, we made enough money there, let's make money somewhere else because it's undervalued.
We were talking earlier, though, just about the Mag 7 in particular and the spending on the cloud. If Alphabet's results are indicative of what we might hear from Microsoft and Amazon next week when it comes to the cloud, where they are spending a lot more than they're able to bring in at this point, is that a problem? Is that because it feels like there's a little bit of a sentiment shift too?
Yeah.
Even if it's a brief one and early on.
I agree. I think perception is really important.
Now you notice everybody agrees on everybody else. Again, I'm not saying it's wrong. It's just all these people are agreeing with each other. That's always a worry. Nobody has a contrarian opinion. But then again, what do you watch these things, right? You watch to make you feel good. You don't want to watch a bunch. You don't want to watch a bunch of people fighting and arguing in front of you. That's too much. You want. It's like when you're a Democrat and you want to watch everything having to do with Kamala Harris. You say, yeah, she's right. And if you're a Republican, you watch everything having to do with Trump. So it reinforces you, right? It makes you feel good. You don't want to say, well, he did this and did that. Oh my God, I have to understand this principle. This is too complicated. Let me go along with the flow. But unfortunately, you want to make money? You can't go with the flow. You want to make money? You got to buy when everybody else is selling, and you have to sell when everybody else is buying. You cannot be buying what everybody else is buying. That's too simple. Because what you don't realize is what they're telling you is they're basically enticing you and leading you and helping you make up their own mind. Remember, they make money not by predicting the stock market, but by taking advantage of the situation. And the situation is that they're telling you, and not just you, 160,000 people, and then we got a bunch of other channel, and he goes around all the time, and he, in fact, is hired by them, right, to invest.
Important for equity valuations, but the money spent by these companies on AI has a high expected return because they have moats that are getting stronger, and there aren't companies like this anywhere else in the world, so they're very scarce. So I don't think it's wasted capital, but if investors want free cash flow or if they see 11 PE stocks and small caps, that's what's become.
Okay, what he's referring to here is basically telling you that you want to buy P stocks and low P stocks, and I agree, and I'll show you a list after. I agree that you want low P stocks because there's studies that have shown that the way you make money in the stock market is not by buying high P stocks. Right now, the P ratio is around, we're at 35 right now. And that's one valuation. Let's see, the one that everybody uses, right? And by Schiller. And by the way, Schiller in 1987, when the market crashed by 20%, October 1987, he actually went out and asked a bunch of people, why did the market drop? And he never got a straight answer, believe it or not. They went to Congress, how could we lose 20% of the stock market value? What happened? They asked question, was there any news or anything that caused it to drop? No, it was just people, all of them together, those 250,000 analysts believe that the market was overpriced. How did they all get together in the same? This is what's amazing about the stock market, right? Somehow these people decide at the same time that that's it, we're done. It's time to move on. And that's a big wave coming in, right? So the P ratio is at 35 right now. And he's basically saying, let's buy the P stocks that are 10. But the difficult part is that you want the stock that is a P of 10, but you don't want a Walmart, right? You don't want a low growth stocks. You want a high growth stock that is actually going to grow. And that's a difficult part. Where are you going to find such a stock? Because if it was a growth stock, it wouldn't be a 10, it would be higher. In addition to that, I mean, the reason why these stocks don't do well historically, the small stocks, well, at least recently, is because last year about 7% of them got taken over. So you have a small company that's doing great, right? If you're Apple or you're Nvidia and this huge market cap, they have a huge amount of availability of financing. What are they going to do? They're just going to buy the small stock. So yeah, if the company gets acquired, you make money because the stock goes up and it gets acquired. But the point is that if it's a small stock, by the time it gets a really good, it gets gobbled up by the big guy. So it doesn't have time to grow. So keep that in mind. And also keep in mind that if the stock is small, right, I'm giving you the other side. If the stock is small and you have an economy, you have a recession, right? So far we don't have that in the mind. But if you keep rates too high too long, you may have one. And frankly, like I said before, if you're a Democrat and you know you're going to lose, because these people think 2, 3, 4, 5 sessions ahead, if you know you're going to lose, well, maybe you give the other guy a recession on his hand by waiting and keeping rates high long enough so that you put us in a recession. That's kind of not good thinking, but you need to think about the other side of this kind of trade, okay? So,
Incrementally attractive.
So a flat S&P, but a Russell or a small cap gain of 15% in the month.
Yes,
Possibly. Yeah.
that's right. I think for the month of August, small caps can do something more than 15% even.
wait, hold on. It's not even, it's more than 15% now.
Because they've underperformed so dramatically. And the type of move we've seen just in the last 2 weeks is something that only happens at the start of a pretty significant advance for small caps.
Now, of course, the perverted part of it is if enough people believe and listen to him and they start buying, they will move, they will overperform.
Do you think that the earnings that we see for the big caps, will they continue to confirm your case that maybe?
Here, we're making a huge assumption is that price risk, the risk of the stock moving up and down, is tied to credit risk of the financials. right? So basically, you're making money, therefore the stock goes up. You're not making money, the stock goes down. But yet, our friend Tom Lee referred before to the fact that historically, some of the pattern that they've seen in the way the stock trades historically for small stocks would imply that you could have a gain going forward. Because, he said in the past we had 1% growth or whatever he was saying, but it had to do with the movement of the stock itself. Basically, the price risk, he's seen some price risk movement in the past that would recover, that would reproduce itself again today. He didn't say that earnings or anything. He just said that earnings that the price risk leads to more price risk, and therefore you need to understand the price risk. A little bit of a contradiction here.
Could anyone blow their results out of the water and change this for big caps and say, wow, we're wrong, things are still okay, so that it doesn't? Because yesterday was 600, whatever it was, 600 plus points. That had a lot to do with earnings. Not completely. It seemed like it was ready to happen anyway. But do you think there'll be any surprises that are better than people thought in that group?
I think so. I mean, at the end of the day, I don't think these companies are not capable of positive surprise. A lot of good news was baked.
So yeah, they could still surprise you, the big guys, and they could make more money. And again, it's annoying to watch this a little bit because maybe it's the nature of my Socrates mentality that I have to question everything. And here we're just going along to get along, or get along to go along, and everything is great. I mean, it's a great job. You just ask a bunch of questions, you're kind of leading questions, and so everything's going to be great. There's nothing happening. What do you think? What do you think? What is what I think you should buy because I'm buying it?
The line in the sand ultimately will be NVIDIA when they report, which is really the last one to report.
Basically, if NVIDIA doesn't do well, then we're all off for the races.
I think over the next 10 years, the outlook is still really good for all these companies. So I don't think investors should lose faith, but profit taking kind of makes sense.
I mean, obviously you don't want to lose faith. I mean, you don't want to get out, right? I mean, these companies are great companies. They've earned. I mean, Apple. I mean, it's not so much that you're losing faith. Is it now time to buy?
That's okay, great. I think we can continue to have you back on because you've been so good on the markets that even that other stuff.
And they're literally telling you with a straight face, we're going to have you keep having on because you keep banging the thing and everything's doing great and you're correct. Now, having said that, I will say that Tom Lee, just ask ChatGPT, has not always been correct, okay? But nobody's keeping tab, right? We're inviting them over, and then if something's bad, they tell them the other way over. Anyway, so that's what's happening. What's happening with our portfolio? What's happening with our portfolio? We're down 16% on Tesla, and we are down 7% on SPY for the options, right? In terms of measuring. Now, what you need to realize is the S&P is down 0.6%, and Tesla stock is down 4.5%. So, again, like I said, with Tesla being 4%, you multiply your losses and your gain. It's magnified through your look what's happening with Tesla here. Right, we're down 16%. We're down 16% because the stock is down. And the stock is down because there's some concern about the big stocks and right. So look, Tesla is down 4.6% today. The SPY, so there's like 4 times, and the SPY, which is basically the S&P, the option of the S&P 500 is the S&P 500 is down 0.63, and I'm down almost 10 times. I mean, that's the advantage, right, about the options. Because I could go back and forth with these people, and you may say, well, is this going to happen, or is that going to happen? I'm a little bit concerned. Well, don't be too concerned, because at the end of the day, maybe you want to play the spread. Remember the option, because options help you manage the uncertainty. Now, what are the hedge funds doing, right?
Welcome back.
So now we're going to listen to what the guy does. And this is This is kind of my strategy really at the end of the day. What do the hedge funds do?
The exchange stocks are pulling back somewhat today after the S&P and NASDAQ both clocked record highs yet again after June's cooler than expected CPI print. And one of Wall Street's biggest bears finds himself
That was 2 weeks ago, okay.
in the bullish camp and has for a while, calling for S&P 6,000 by year end. But could uncertainty surrounding President
Well, this guy is the opposite of Tom Lee, and he thinks that the S&P is going to do very well, actually.
Biden and the election or any number of geopolitical risks derail this rally? Let's ask Brandon Yarkin. He's the chief operating officer at Universa, the tail risk hedge fund advised.
Now, Universa made 4,000% at the time of the last 2020 COVID crisis.
Black Swan author Nassim Nicholas Taleb, who's also been on this program. Brandon, it's good to have you here. Welcome.
No, Taleb Nassim, I have to tell you, tells you with exactly what Socrates has been saying, which is you don't know. You should know that you never know. Know that you don't know.
Thank you for having me, Kelly.
So let me try to explain, as I understand, you can correct me where I'm wrong. Instead of doing kind of 60-40 traditional portfolio diversification, you guys look at basically you stay long, but you have this, hedged exposure against cataclysmic market.
That's what you should be doing. You should be long. I'm not saying sell your stock, but you need to protect your book. That's what they do. They protect their book, protect your investments.
I mean, do I have it kind of correct?
That's very good as a summary. And again, most people, when they think about the 40 in their portfolio, what purpose is it serving, right? The 40
Bonds,
in their portfolio, right?
Yeah.
Let's say it's bonds.
Or
Let's say
whatever.
it's, sure you.
Now, as you could see, the S&P, the Universal Tel Hedge, 2000 March, December was 9.5%, right? Versus if you had 100% S&P and 60% bond, you would have lost 13%. 60-40, well, they made a mistake, yes. 100% S&P and 60% bond and 60% 40 would have lost 5%, right? Over the past 5 years, they beat everyone basically. That 98% S&P, no bond, but 2% Tel hedge. Look at their return. They are beating the return. It's a 2%. This hedge is basically the option that I've been talking about.
People on here that espouse other strategies like hedge funds and CTAs and things like that. But at the end of the day, it's risk mitigation, right? It is meant to protect
Risk mitigation. That is what you need to do.
you against these cataclysmic events in the same way that tail hedging is meant to protect against these cataclysmic events. But what you find is that the things that you're using to protect yourself against the event is more costly than the event itself.
Right.
The cure should not be worse than the disease.
A lot of people experience this right now with literally auto insurance and home insurance. They go, at some point, I'd rather be uninsured if it costs too much. So just back up for a second. What is tail hedging?
So tail hedging is essentially making sure that in these large losses, these big, large market declines, that
So basically, that's what you're doing. You're hedging, you're buying protection, you're buying puts, which I will add to the portfolio, so that if something happens, keep in mind, and I'll do a video on that, this cataclysmic event, right? We have a bunch of wars kicking up all over the place. I think Turkey recently announced that they were going to invade Israel. I mean, imagine the idea of that. There's a lot of things happening in the market, and they might happen, right? There is the $1 trillion that we owe, that at some point they're going to say, enough is enough. It's not going to happen at the end of the year. There's also the fact that we are overextended right now with the S&P. There's also the fact that they might wait to raise rates, to lower rates until you get into a recession. You also have the fact that you have elections coming up. You have a lot of uncertainty here, right? And this is usually when you something happens that you don't expect, that people run for the exits. So he's going to explain to us what I just told you.
your portfolio does not lose significant amounts of money.
And how do you do that?
We do it through option strategies, right? So we have highly explosive convex positions that when things are going good, like I said, we've been bullish since.
Well, look what I showed you. Convex position. I've got this call, right? The market went down 1%, not even, and I'm down 7% on the call option on the SPY on the index. right? So it's huge convexity. It's magnified, but the gain is magnified, right? Depends where. Right now I'm just playing around, but it depends where you want to be. If you're negative, if I would have put a put, I would have made money.
2022, we've been reiterating this kind of bullish tactical call, but our forecast of markets doesn't matter at the end of the day because we have such a highly explosive position should the eventual black swan happen.
And that position's not too expensive to carry over a long period of time?
It's a good question, and it's a matter of framing. If we have a position where
now it's very difficult. I mean, this is not for everyone because obviously here you are paying, because keep in mind everybody's thinking I want to make money, right? Here I know for a fact that it's going to cost me money. It's like an insurance for your house. It's going to cost you money to insure your book. It's going to cost you money. And then you say, well, but the market is doing great. What am I losing here? Yes, you're reducing your gain. That is true because you're making money in the S&P, but you're losing on the options. So what's the point? I want to make money everywhere, but that doesn't happen all the time. But the point is that if you keep doing it, if something happens, that position is going to go like this. Well, this is going to drop like that, making up the losses, the difference in the losses. In addition to that, while they're going to make money on that option, they will be able to buy stocks with the money that they made through the option.
Is more than the disease that we're trying to protect against, and you shouldn't have it on. We argue that, again, most financial products are in that camp, but our cost at a portfolio level, if we never see a crash again, right? The market goes up like it has been this year and in 2023, and it has for 15 years forever, and the Fed does its job and prevents market crashes. It doesn't mean that our strategy would.
One thing you have to remember also, you have geopolitical event, you have the uncertainty of the election, you got lots of things that could be happening. But also you need to realize that there is a lot of pent up demand for potentially event that you haven't planned. That's what they call the black swan. You don't know when it's going to happen, but if it does hit, what do? Can you protect yourself against that unlikely event?
The wrong investment strategy. Sure. You have to think about what portfolio do I have that has tail hedging in it versus a 60-40, and how do those portfolios do as the market rises, and how do they do in the market?
One more question in this vein, I want to kind of broaden it out, but is it worth paying a fund like yours to provide this strategy when a lot of retail investors, as they've gotten more sophisticated, could probably do something like this themselves?
That's a ridiculous question because, option trading is very difficult. You could make some money if you're right, if you're lucky, but you have consistently doing it. That's difficult. Don't forget, these guys have Spitznagel, who's his boss, have done this for years, and they're very, very, very astute with it.
That's a great question. I would highly encourage retail investors to not try to replicate strategies like this. And the devil really is in the details when it comes to.
No, you will notice one thing. Tommy Lee made about 180,000 views, right? Do you see how many views this guy has? 3,600. That's the guy you want to listen to. That is the guy that you want to follow. Why? Because nobody's watching him, right? Nobody's watching. You want that. You want to buy when everybody else is selling and sell when everybody is buying. You don't want to follow the crowd because that's how you make money in this market. In any way, you got to be first.
Options, and particularly options, are very high transactional cost instruments. So, if you're looking at options, they could be, several 100% wide bid-ask spreads. Imagine.
Plus, he's talking about options. He's talking about things that most people don't understand. Hopefully, my audience, you will understand what it is. As you can see, he's talking about stuff that nobody really understands or feel interested in because they don't understand it. The other one is easy. He talks in like Santa Claus kind of stuff. This is much more difficult.
Google. Google trades in dollars, right? Fractions of basis points. This is hundreds of times, right? Equivalent. So you definitely do not want to do this on your own. I think that our real focus in trying to educate people on things like what the 40 is doing in your portfolio is how expensive it is, and be aware of all of these forecasts, the Biden.
Right.
the all of these other different macro positions that you're in, and the decisions that you're making cumulatively over time, and how.
Most people probably don't understand what he was talking about because it's very difficult. So, in conclusion, what you want to do is you want to make sure you understand what's happening in the market. You need to understand what these people are telling you, and you need to form your own opinion. That is key. And right now, what's happening is there's a rotation trade. In another video, I will show you a couple of names that I've been working on. But basically, there's a rotation trade going on. What does it mean? Well, it means that the market might be going up, but it also quite possible go down, or at least rotates away from S&P. But that's what's happening. Is this really what the trade should be doing? I don't know, but you should protect your book as well. You should make sure you have options, just in case we have a recession, just in case we don't like the election, just in case there is geopolitical event, just in case of anything, right? And then if you're wrong and you think things are good and your option is performing, then you unwind it. And obviously, the shorter the option, the more the gain. Stay tuned, and thanks for tuning.